$21 billion. That is how much foreign investors have pulled out of Indian equities in just the past 2 months. A massive capital outflow, the sharpest since India opened its market to global investors in 1993. And this comes on top of last year's selling of roughly $20 billion, taking total foreign withdrawals into tens of billions of dollars. Foreign ownership in Indian equities has now dropped to a 14-year low of 14.7%. According to the Financial Times, this is not a one-off shock, but part of a sustained and widening withdrawal by global investors. Goldman Sachs estimate that remaining foreign selling could be limited to around $4 to $5 billion, but it adds a key warning. This does not imply a quick return of inflows. Even when global conditions briefly improved with easing geopolitical tensions and stabilizing commodity prices, foreign investors did not meaningfully re-enter Indian markets. At the same time, global institutions are turning more cautious on India's positioning. HSBC has downgraded Indian equities to underweight. JP Morgan has cut its stance to neutral, and Standard Chartered has reduced India's growth forecast to 6.4% from 7.1%, citing risk from oil prices, geopolitics, and slowing demand. The message from global finance is increasingly aligned. India's risk premium is rising. Pressure is also visible in currency market. The Indian rupee has weakened to record lows, around 95.7 per US dollar, driven by debt repayments, importer hedging, and sustained dollar demand, with limited support from policy measures. As a result, India is now underperforming not just Asia, but much of the broader emerging market universe as global capital continues to rotate elsewhere. So the story is no longer just about outflows, it is about what the signal. Is this simply a pause in capital flows or the beginning of a deeper repricing of India in global portfolios?